As expected, the Federal Reserve lifted interest rates by another 0.25% to the highest level in 22 years. But why would the US dollar fall? Well, it's because Fed Chairman Jerome Powell revealed that the economists on his staff are no longer forecasting a recession. It was the most forecast recession in history, and it meant that the Fed was supposed to start cutting rates in December. But now, probably not. So the US dollar fell in response to that, and the Aussie dollar popped above 68 US cents for a while before closing just below that. It means the Australian cash rate is marooned well below the US rate, which is very unusual. As this chart shows, Australian rates are normally well above America's because ours is a small country far away, so we have to pay more for capital. So our mortgage rate is normally higher than America's, but now it's lower. And it's usually with the inflation rates roughly the same, but now Australian rates are lower even though our inflation is higher. And one reason for that is that the US has 30-year fixed-rate mortgages and we don't. So the actual rate that Americans pay outstanding has barely changed, unlike ours, and the Fed is spinning its wheels. The RBA, though, is getting more bang for its hikes. The share market went up thanks to solid gains by retailers and banks. The Dow Jones has increased 13 days in a row in the US, which is the longest streak of gains in that index since June 1987. And there were small moves on commodity markets, iron ore, oil and copper down, gold up. And that's finance.